This is called an ANOVA table. Ordinary least squares method, sometimes also known as regression. Firsts of ordinary least squares, which is simple linear regression method, which is a cost estimation method that requires you to form simple linear regressions of the form y is equals a plus what? bx, okay, where a is given by the summation of y minus b summation of x divided by who? N. Then the value of b is n summation of xy minus the summation of x summation of y by n x squared minus the summation of x. You do what? You square. Now the difference between these two, is simply this: you're squaring x individual, but here you first get the total of x, then you do what? You square. You first get the total of x, then you do what? You square. All right. There are certain steps we can follow. Your steps using your calculator. And the calculator I want us to use is FX82 MS. Is your calculator known as FX82 MS. The first step there is always to switch on your what? Calculator. Always to switch on your calculator. That is a first step. Once we have switched on our calculator, the second step is to reset your calc. Reset the calculator. And you reset your calculator by pressing, shift mode all, which is given by number 3, then equals. That is the second step, resetting your calc. Now you reset your calculator because you may have previously saved data. And that previously saved data will affect the results of your equation. So therefore reset it so that it doesn't affect the results of your current result that you intend. The third step is to do what? Is to set calculator in a regression mode. How do you do that? You press mode, then regression, then regression is denoted by number 3, then linear denoted by number 1. Step 4 is input your data. When you are inputting your data, how do you input it? You input it in the form of x, y, m plus. X, y, m plus. This m plus here simply means memory addition. That m plus there means memory addition, which is the same function like in your computer known as what? Save. So this is known as save. So you add that, or you press m plus so that you can add data in your calculator and store it there. Then I want us to do this December 2024 together. We do this December 2024 together. And I want you to show you how we input that data, how we input it. I hope we have reset our calculator. We have set up the calculator in regression mode. I want to show how now you input it. X is 1425. So what do? You're going to press 1425 in your calc. The next to the DEL and AC buttons, you press 12185 and then M plus. Remember, the comma and the M plus are slightly above the DEL and AC buttons. Slightly above the DEL and AC buttons. If you press 1425, comma, 12185, M plus, N should give you 1. N is equal to 1. The next observation is 950, comma, 9875, M plus. So that is the second observation. The third observation is 1190, comma, 10450, M plus. The fourth one is 1690, comma, 15 to 80, M plus. 1006, comma, 9915, M plus. 834, comma, 9150, M plus. 982, comma, 10133, M plus. 1259, comma, 11981, M plus. 1385, comma, 12045, M plus. 1420, comma, 13180, M plus. 1125, comma, 11910, M plus. 980, comma, 10431, M plus. So that now the last observation of 980, 10431, after you press M plus, N will be equal to 12. N will be equal to 12, okay? Then the next step is to obtain your data. The data values which are unknown to us. And so far you don't know the value of all this, you also don't know the values of all that. But since you have imputed everything in your calculator, you can be able to obtain them. And how do you do that? You simply press Shift 1. Press Shift 1. When you press Shift 1, the first screen, there is a summation x squared, the summation of x and who? N. To select any value, you press the number below it. For example, when I want this summation of x squared, I'm going to press 1, then equals. So that will give me 17, 483, 772. Press Shift 1 again. When I want the summation of x, I simply press 2, then my equal sign. 14186. Shift 1, then N is given by number 3. I remember to press my equal sign. That will give me 12. Okay, that being the first screen, we can go to the next screen by pressing Shift 1 and your arrow key. Shift 1 and your arrow or direction key to the right. In the calc, there are 4 buttons just on top of your calculator. Between alpha and mode, there are 4 direction keys there. So you're pressing Shift 1 and moving to the right, such that the summation of y squared can be obtained by pressing 1, then equals 370, 811, Shift 1, the summation of y, move with your direction key, the summation of y is 136, 535. The summation of xy all right. Now if you look at your formula for b here, we have everything except this here. This is the only item you don't have, but since we know the summation of x, we simply square it and say the summation of x squared will be 14,186 squared, will simply be 14,186 squared. Right, that is when you use shift 1, or that is how you use shift 1. Now to obtain our values of a and b, we can simply use what? Shift 2, and we move with the direction key twice to the right, shift 2, and move to the with the direction key twice to the right, starting with a. You're going to press the number below that, which is 1, then equals 295. Shift 2. B, the number below that is 2, so press 2, then equals 6.48 692. But we know our equation should be of the form y is equals a plus what? Bx. The value of a is 3709.295 plus 6.48 692 of who? X. 6.4869 of who? Of x. And that is how we form equations using what? Simple linear regression method. Using simple linear regression what? Method. Right. The next thing we should be doing, or I should show you, is how you're going to deal with multiple regression. So multiple regression. Allow me to do away with this. We will come back to evaluation. There's a concept there. So we will need to evaluate. I will show you how to evaluate your what? Regression equation. But before that, let me show you how we deal with what? Multiple regression. Before we come to the evaluation, let's talk about multiple regression. Multiple linear regression method. Just multiple linear regression. Now, with multiple linear regression method here, this is a regression method where you use it when you have more than one independent variable x. When we talked about simple linear regression here, x is only one, y is equals a plus b, x is only one independent variable. But it is possible that you have more than one factor affecting your costs. Okay, so where you have more than one independent variable or a factor affecting your cost, you're going to introduce the concept of multiple linear regression method, but your equation is still a straight line. So it must be of the form y is equals a plus b1 x1 plus b2 x2 all the way to bn xn, where x represents your independent variables. How many independent variables are there? So if you have an independent variable for who? For income, you will have it. If you have an independent variable for age, you are going to do what? To have it. So either way, this is how you form a regression what? Equation. That is the general form of your regression what? Equation of more than one independent variable. Of more than one independent what? Variable. All right. Once that is done, I want to show you how you do what? How you are able to form what? Predictor equations. How you're going to form predictor equations. So I want us to go to last sittings question. I want us to go to last sittings question. So I want us to talk about April 4B. Question 4B. April 2025, question 4B. They're saying Global Logistics Limited has two operating segments, Longonot and Zoya. Longonot division orders most of its consignment of immediate output from Zoya division using economic order quantity model. The managers of each division are given considerable autonomy in transfer pricing policies. Longonot division managers want to use multiple linear regression analysis to evaluate the significance of the independent variables on material handling of cost of its consignments. And they also say the finance director of Global Logistics has availed the following data for Longonot Limited for the past 10 months. You have your month, your material handling cost is Y, number of orders is X1, number of kilograms is X2. The computer output is as follows, so you have that note number 1. Then analysis of variance table, you also have it there as number 2. And number 3, then required, write down the multiple linear regression function of y is equals to a plus b1 x1 plus b2 x2. So allow me to copy this table. There are 2 tables, or rather there are 3 tables that I will need to copy so that I show you how you get those what. This is called an ANOVA table. It's the one I want to copy, which is what we refer to as analysis of who? Variance. Analysis of variance table. I'm copying this so that I can show you how you obtain your various what? Your various equations when you're given an ANOVA table. When you're given an ANOVA table, I want to show you how you get your regression equation. So you have your regression. Regression is also known as model, residue is also known as error. 2, 7, total is 9, 34, 6, 1, 3, 0, 2, 0, W, 34, 653, 200, 17, 30, 65, 10, 57, 39.99, 15.06, 0767, 22. Then you have your parameter estimate table. You will have your variable, coefficients, standard error, and your T ratio value of your intercepts, x variable 1, x variable 2, 5 of 7.3097, 7.83, 5162. 57, 3225, that is Z, 0.0037, 42, 8.85, 009, 8, 33, 0.47672. This is 28. Two 286. Okay, here there are some certain variables that are unknown. This is W. Let me use a different color pen. That is Z. That is Z. Okay. Now, the first part of that question, they're saying write down the multiple linear regression. The form y is equals a plus b1 x1 plus b2x b1 x1 a plus b1 x1 plus b2 x2. Now, the first thing you realize is that x1 and x2 you must be given, okay, and also that you must be given, where we know x simply means the independent, y means the dependent. In this case, x1 is number of orders. Number of who? Orders. X2 is the number of kilograms. You must select those two. Number of kilograms ordered. Y is your material handling cost. Y is your material handling what? Cost. So Y will be, you know, A is normally the what? The independent variable known as the intercept of Y, and the intercept of Y is here. The intercept of the coefficient, so Y is 507.3097 plus the coefficients of x1 and x2 are the ones you're going to refer to as your what? B. B. So B1 here will be 7.835162 of x1 plus 0.10781 of x2. So these coefficients here are the ones that give you A, B, and all the B's. All right, that is that. Part 2 of that question. They were telling us, suppose in the month of April, long or not division expected to have 350 orders with 17,000 kgs of material ordered. Predict the total material handling cost for the month of April 2025. So this second part here is what we refer to as estimation or forecasting. Forecasting is where you use your relationship here. This relationship is cost estimation. Use this relationship to predict future what? Cost. So they are simply asking you for your future what? Material handling cost. When you have ordered how much, you have made 30 orders and received 17,000 what? Kgs. So you're going to say Y when x1 is equal to who? 350 orders, and x2 is equal to who? 17,000 is equal to 17,000. So you simply now substitute, you know, the equation of Y is 507.3097 plus 7.835162 times 350 plus 0.10718, but you are ordering 17, you received 17,000. So let's work this one out. 507.3097 plus 7.83 5162 by 300 plus 0.10 7181 by who? 17,000. So the total cost of what? Of materials is 4679.9353, and that is how you deal with what? How you deal with multiple linear regression, on how you solve your what? Your equation, all right, or how you form your equation. That is good. Now, once you have formed your equation, the next thing we should do is to evaluate what is this equation good for prediction, or is this equation using the least squares or the simple linear regression, is it significant, or can it be used to predict? Or if used to predict future cost using these two equations, are the costs going to be accurate, or are they not going to be accurate? So, and for you to do that, you now use various methods of what? Analysis of what? The regression equation. There are various methods that we tend to use to analyze your regression equation. The first method is what we refer to as economic plausibility. We refer to it as economic what? Plausibility. So now we are introducing another concept. We are introducing another concept of analysis or analysis and interpretation of regression what? Equation. Analysis and interpretation of regression equation. Okay, which is still under this.
Hello and welcome to the Manifested e-learning platform. Today we are going to work out an illustrative example on CVP analysis. The example is from the KASNEB past papers. This is the sitting that was done in August 2024. Question 3 has 3 parts, A, B, and C. Part C is the part that we are interested in, but for the sake of revision, we will still solve or answer question A and B. Question A of the question reads, explain the following theories of valuation. 1. Technical theory, 2 marks. 2. Fundamental theory, 2 marks. 3. Random walk theory, 2 marks. That is part A of the question. So let's answer part A, then we'll answer part B, then C, one section at a time. Now, these are 3 theories of valuation of stock. These are stock valuation theories. The first one is technical theory. What do we mean by technical theory? So we are answering August 2024. August theory. Just 2 marks. Technical theory is one of the 3 stock valuation theories. It may also be referred to as technical analysis, and it asserts that stocks value and future price movements can be predicted by analyzing historical market data, primarily the price and volume. That is the technical theory in brief. Of course, here you are just to say that, then you earn the 2 marks. It is stock valuation theory that asserts that a stock's value, the value of a share, and future movements can be predicted by analyzing historical market data. This theory asserts that, what does it assert? It asserts that a stock's value, a stock's or a share's value and price movements can be predicted, by analyzing historical market data. By analyzing historical market, primarily price and volume. Primarily price and volume. By analyzing the historical market prices and volume of stocks or shares, then one can predict the value and price of a share. One can value. Do you understand? Technical analysis. The value of a share and future price movements can be predicted. It's possible to predict what will be the price of a share in future by just analyzing historical market data of the share, primarily analyzing the past price of the share and the past volumes of the share. That is the meaning of technical. And candidates can go further for the sake of understanding this concept and state that it operates on the belief that prices move in trends which repeat over time, reflecting the collective psychological behavior of investors. This theory ignores the intrinsic value, okay, and use tools like charts, moving averages, indicators to identify patterns, to forecast short-term price direction and make trading decisions. So that is a technical theory. 2 marks. Part 2, we have fundamental theory. Fundamental theory. 1 2. Fundamental theory is another stock valuation theory. Holds that a stock's true value or its intrinsic value is determined by the underlying economic, financial, and management factors of the company. Do you get it? It holds that a stock's true value. It holds that a stock's true value, this theory holds that a stock's or a share's true value, the true value of a share is also known as intrinsic value. This theory holds that a stock's true value or intrinsic value is determined by the underlying number 1, we have economic, financial, and management factors. And management, you don't determine, when dealing with this theory, you don't determine the value of a share by predicting, by studying the past historical market data. No, you look at the underlying economic, financial, and management factors of the company. It involves a deep dive into a company's financial statements, like the income statement, the balance sheet, the cash flow statement, right? Its industry, its competition, and the overall economy. The goal here is to estimate the intrinsic value using methods like the discounted cash flow, and then compare it to the current market price. And if the market price is lower than the intrinsic value, then the stock is considered undervalued and a good buy. You can buy such a share. Fundamental, you go to the fundamentals. You analyze the fundamentals, the balance sheet, the income statement, the cash flow. You look at the economic factors. That's what we mean by financial. Then we have economic factors. You analyze the industry within which the company operates. You analyze the competition and the entire overall economy. By doing so, you'll be estimating the intrinsic value of a share. Then once that is done, when you get that intrinsic value of a share, you then compare that share with the market price of the share or stock. Now, the market price, we know, is determined by the forces of demand and supply. If it is the company that is listed on the stock exchange, then what is listed on the stock exchange, that will be the market price. So that market price is then compared with the intrinsic value. And if the market price is lower, than the intrinsic value, then the stock is considered undervalued and vice versa. And if it is undervalued, then that is the right stock to buy. That's the meaning of fundamental theory. Then we have random walk theory. Number 3, random theory is yet another stock valuation theory. Posits that stock price changes are random and unpredictable. Stock prices. It posits that stock price changes are random. Price changes are random and unpredictable. They are random and unpredictable. They are what? Random, predictable. This theory argues that the current stock price already reflects all the available information, both public and historical, due to the rapid and rational actions of countless investors. And therefore, no form of analysis, neither technical or fundamental, can consistently predict future price movements to gain an abnormal profit. That is to mean that the theory implies that an investor's best strategy is often to hold a diversified, passively managed portfolio. This theory posits that it's not possible to predict the future value of a share, whether you are using the technical analysis method or fundamental method. The stock price changes are random. That means they are not predictable. You understand what it is? Yes, that is what was required to earn the 2 marks for each part of the question. Technical analysis, 2 marks. Fundamental theory, 2 marks. Random walk theory, 2 marks. Now let's move to the second part of the question. The second part of this question reads that Lima Limited paid a dividend of 15 shillings per share in the last accounting year. The dividends are expected to grow at the rate of 10% for the first 4 years and at the rate of 12% thereafter in perpetuity. The investor's expected rate of return is 15%. Required, determine the intrinsic value of Lima Limited's ordinary share. 6 marks. 6 marks. This is part B. Part B. Part B. Part B, we are required to do what? Determine the intrinsic value of the Lima Limited's ordinary share. Value of the share. That is what you are required to do. Now, to determine the intrinsic value of these share candidates, we will Look at the question again. You can see we are told that the dividend, the value of the dividend is 15 shillings. 15 shillings. So, to determine the intrinsic value, we will first of all grow the dividend at 10% for the 4 years. We grow that dividend because we are told the dividend will be growing. Okay. After growing this dividend for the 4 years, we then discount the dividends by multiplying the value of the dividend with the present value interest factor at 15% and the number of periods. We discount, then get the present value. Then we are going to get the sum of the discounted values. That is what we are going to do in order to determine the intrinsic value. Then at the end of the 4th year, we know that we will also do a discounting. So we have this table, but we are going to have a table. Column 2, we have dividend. So for example, year 1, look at the question. Year 1, that dividend of 15 shillings will grow at 10%. So we are going to multiply this 15 by 1.1. We raise to 1. Value of this dividend at the end of year 1. Then at the end of year 2, we'll again multiply 15, 1.12. Year 3, it will be 15, 1.1, we raise to 3. Year 4, 15 into 1.1 raised to 4. So these will be the values of the dividends for the 4 years. We are growing it. 1.1 means, candidates, it will grow at 10%. That will be 100% plus 10%, which means that will be equal to 110%. If you are to convert 110% into decimal, it will be 100. It will be 110 over 100, which is equal to 1.1. That's how I get 1.1. It is 110%. It is growing by 10%. So it will be 100% plus 10%, giving us 110%, which we convert into decimal to get 1.1%. Then that's how you grow it. So I'll take my calculator and grow the dividend. That will be 15 times 1.1. I'm getting here 16.5. Then I have 15 times 1.1 raised to 2. 18.15. Then I have 15 times 1.1 raised to 3. This is 19.965. Then lastly I have 15 times 1.1 raised to 4. 21.9615. 21.9615. These are dividends. Then we multiply these values with the present value interest factor at 15%. The values here, the present value interest factors, we read directly from the table. The present value table. If you look at the present value table, at 15%, 1 year. Period is 1 year. It gives you 0.8696. Now, if you don't have a table, then there's an alternative way of getting the interest factor. There's an alternative way of getting this interest factor. Okay, if you don't have a table, that will be 1 over 1.15 raised to 1. So that will be 1 divided by 1.15. Yes, 86.96. This is how you get it. Then for year 2, it will be, if you are not using the table, this is how to determine the present value interest factors. For year 2, it's going to be 1 over 1.15 raised to 2. Okay, so that will be 1 divided by 1.15 raised to 2. 75.61. This is 0.7561. Then just reading from the table, I will give you an alternative way candidates, but this can be read directly from the table. If you are in the exam room, you don't have it this way, unless you are given a rate that cannot be read from the table, then you use this formula. But for the purposes of exam and time management, you don't have to go this long route. Just read directly from the table. You can read the present value interest factors directly from the table. Third year read from the table is 0.6575. 0.6575. Then year 3, year 4, 0.5718. Are you following, candidates? Yes. So these are the present value interest factors. Then you recall, candidates, in year 4, again, in year 4, apart from this dividend growing, this dividend, we also need to discount the value of the dividend P0. To get the value of P0, we know this is equal to D0 at year 4 into 1 plus G over KE minus G. So our P0 here will be equal to D0. D0 is the 21. This will be 21.9615. We grow it at 1.1, 1 plus G. The growth rate. Do we have the growth rate from the question? Do we have the growth rate? Do we have G, the growth rate? Do we have the growth rate? Look at the question again. Look at the question. Are we given the growth rate? The growth rate. We have the growth rate. Yes, we are told. Look at the question. We are told that the dividends are expected to grow at the rate of 10% for the first 4 years. So we have grown this dividend. Look at the board. We've grown this dividend. We've grown this dividend for the first 4 years. Then after 4 years, we read, and the rate of 12% thereafter. After growing this dividend at 10%, thereafter it will be growing at the rate of 12% in perpetuity. So it's going to be 1.12 and not 1.1. Okay, so it's growing at that rate. So we divide by KE. KE is the cost of equity, which is 15%. 15% converted into decimal will be 0.15. Then the growth rate of 12% converted into decimal will be 0.12. Are you following, candidates? Yes. So there are two growth rates, 10% 12%. The first 4 years, 10%. The last year, 12%. So that will give us the value of this dividend, P naught. So we go to the machine, calculator, get the calculator, punch in these figures. Punch in the figures. What are we getting? This is 21.96 into 1.12 divide by 0.15 minus 0.12. This is equal to 819.896. So the discounting, because it's 4 years, the discounting factor is going to be 0.5718. So that's it. So the last column here is to calculate the present value. Then after calculating the present value at each period, we get the total here. That will be the value of this dividend. So you multiply the present value interest factor with the dividend to get the present value. This is called discounting, because this 16.50 is the value of the dividend after 1 year. This is the future value. To determine the present value, we multiply it with the present value interest factor. So year 1 is 16.5 times 0.8696. This is equal to 14.3484. 14.3484. Year 2, we multiply 18.15 times 0.7561. Give us, this is 13, this I mean, this is 13.723215. Next we have 19.965 times 0.6575. This will be equal to 13.1269.875. Then we have 21.9615 times 0.5718. 12.5575857. Then lastly we multiply 819.896 times 0.5718. This gives me 5328. So with that, we have all the present values. So we sum all the present values to get the value of this dividend. So we're going to get the intrinsic value here by adding all these present values. So this gives me 522.816. This is 0.57, there are many decimals, 5727. So this is the intrinsic value. That is how to determine the intrinsic value of a share. So the intrinsic value is equal to shillings 522 and 60 cents. That's the intrinsic value. That is the intrinsic value. So that is the intrinsic value. And that is part B of the question, August 2024, question 3. Now allow me to move to the next part of the question, which is on CVP. CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180. Variable cost per unit is 80 shillings. Fixed cost per annum 5 million. Required Roman 1, break-even point in shillings and in units for marks. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. It's just 100. This is equal to 50,000 units. Now this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 unit. So that's the break-even point in units. Then to calculate the break-even point in shillings, that will be equal to the fixed cost over contribution margin ratio. Contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost. That gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0.0 0.555555. So we divide the 5 million. This gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this will be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates will calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. You have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class? This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit, then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin. Because it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions I've answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye. Hello everyone, and welcome back to the lesson. We continue with the topic mergers and acquisitions. We'll, in our today's lesson, cover the second valuation model for mergers and acquisitions. Remember, in our last session, we stated that there are 3 main valuation models. That is the asset-based model, the market-based model, and the cash models. Today we focus on the market-based models, which use market data to value acquisitions. So the market relative models may be based on, say, the price earnings ratio, which produces an earnings-based valuation of shares, and that could be one of the most sensible starting point for valuing a listed company. Okay, so listed companies, the most sensible starting point is a use of market-based earnings, market-based models. So if the stock exchange or if the stock market is efficient, then the market price will reflect the market's assessment of the company's future cash flows and risk. And by now, I know you understand that the difference between a company's share price and its earnings figure is its PE ratio, which also indicates the market's assessment of the company's future cash flows and risk. And therefore, a higher PE ratio may indicate optimistic expectations. If a company has a higher PE ratio, it indicates optimistic expectations. These are expectations that the cash flows and earnings will grow rapidly in the years to come, so that a higher price is being paid for future profit prospects. So if an acquirer is paying now, then the acquirer has the expectation that the company's profits will increase in the future. That is one indicator of a higher PE ratio. Another indicator of a higher PE ratio is a security of earnings. Security of earnings, such that a well-established low-risk company would be valued on a higher PE ratio than a similar company whose earnings are subject to greater uncertainty. So we have the PE ratio or method as one of the market-based models. So a PE ratio can be applied to valuing a takeover target by taking the latest earnings of the target and multiplying by an appropriate PE ratio. So you take the earnings, then multiply by an appropriate PE ratio. You understand? So market-based value, in other words, candidates, market-based value would be equal to the PE ratio times the earnings, all right, of the target. Earnings of the target. So you take an appropriate ratio, then multiply it by the earnings of the target, you get the market-based value. You understand? The earnings of the target shows the current profitability of the company. The earnings shows the current profitability of the company. Then the appropriate PE ratio, which reflects the growth prospects or risk of the company. So market-based value based on PE is equal to the appropriate PE ratio times the earnings of the target. All right? And candidates, earlier on I indicated that the market-based models could be used particularly for the companies that are listed on the stock exchange. If the company that is being acquired is quoted on the stock exchange, then the market value is clearly the minimum that the shareholders in the company would be prepared to accept. And that therefore there is it should be the starting point. The minimum amount that they could accept is what is trading in the market. market value on the stock exchange. So we have the market value on the stock exchange. Then number 2, we have the price earnings ratio. What I have indicated here, the price earnings ratio. These methods could be based on the market value of on the stock exchange or the PE ratio, the price earnings ratio method. You can use the price earnings ratio method, the price earnings ratio method, which is the most common market-based method in practice, especially when valuing a company that is not quoted on the securities exchange. If a company is not quoted on the securities exchange, then we may use the PE ratio method. You understand? So we take the PE ratio of a similar quoted company, or even just the average PE for the industry, and apply it to the earnings available to the shareholders. That is profit after tax of the company that is being valued. So if you are valuing an unquoted company, then we should reduce the PE ratio and arrive at a lower value in order to reflect the fact that the shares are currently not marketable. You understand? The PE ratio method. Then we have the earnings yield method. Earnings yield method. The earnings yield method or approach. Because candidates, whereas the PE ratio market value or the market value and the EPS value, we know the earnings yield is just the inverse of the PE ratio. You understand? So we take the earnings yield of the similar quoted company and apply it to the company that is being valued. That is being valued. So we may have 3 approaches. Market value on the stock exchange when valuing a target, or especially the company that has quoted in the securities exchange. If a company is not quoted in the securities exchange, we may use the PE ratio method, or we use the earnings yield method. Now let's have an illustration. This is again August 2023, question 4. The statement of financial position of 2 companies, ACO Limited and Biro Limited, as at 31st December 2022 are shown below. So we have the statement. Then additional information number 1. ACO Limited is proposing to acquire Biro Limited by means of an issue of its own ordinary shares in exchange of the company's shares of Biro Limited. Number 2. The management of the 2 companies have availed the following information to assist the takeover. So we have the maintainable annual profits after tax attributable to equity shareholders, current market price per ordinary share. We have the current earnings per share. The tax rate is 30%. Using earnings per share basis and market value basis, and assuming no synergy effects accrue from a takeover, determine the total number of shares the directors of ACO Limited will have to offer to the shareholders of Biro Limited. That is the question. That is the question. So let us answer it. We are to calculate the number of shares based on EPS, based on EPS, earnings per share. Illustrate. This is KASNEB past paper question. August 2023, question 4. Using earnings per share basis. Using earnings per share basis and market value basis. Those are 2 approaches. So let's begin with earnings per share basis. The earnings per share basis. Using the earnings per share basis, what is the question? The question is, determine the total number of shares the directors of the acquirer would have to offer to the shareholders of the target company. So here we have to calculate the number of shares to be issued to acquire the target. That is the question. The number of shares to be issued will be equal to the exchange ratio times number of shares of the target. We do not have the exchange ratio, not have the of shares of the target. Have some workings. Let me have the workings here. Workings. First of all, we need to have the working for exchange ratio. Exchange, we need to get the exchange ratio, and we are using the earnings per share basis. The earnings per share basis. So the exchange ratio would be the EPS of the target divided by EPS of the acquirer. EPS of the acquirer. So what is the EPS of the target from the question? From the question, not number 2, the EPS, do you have it? We have the current EPS is 2.4 and 3. So we have 3 divided by 2.4. What is the exchange ratio? What will be the exchange ratio? Calculator. That is 2.3 divided by 2.4. 3 divide 2.4. 3 divide 2.4. This is 1.25. Is it 1.25? Yes. So 1.25 is the exchange ratio. So we come here and plug in 1.25, multiply by the number of shares is 5 million. We divide by 10. 5 million is the total value of shares. 10 is the par value. So we're going to have 500,000 times 1.25. The total number of shares to be acquired or to be issued is 6,000 shares. That's the answer using the EPS method. Then using the market basis method, market value or basis method, the number of shares, formula, number of shares to be issued will be equal to, again, the exchange ratio. We take the exchange ratio, multiply by the number of shares of the target. So this is working 1. Working 2, exchange ratio. We take the MPS of the target, divide by the MPS of the predator or acquirer. What is the MPS? The MPS of the target from the question is 2724. This is equal to 27 divided by 24. How much is it? 27 divided by 24. That will be the exchange ratio. 27 divided by 24. 1.125. 1.125. 1.125. This is equal to 1.125 times 500,000. thousand. So 1.125 times 500,000, the exchange ratio, is equal to 562,500 shares. This is the number of shares to be issued to the target, 565 shares. Is that clear, candidates? Yeah, that effectively brings the lesson to an end, where we have learned how to value a target using the market-based valuation methods. Thank you for attending the lesson. In our next session, we're going to cover the cash basis method. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today I want us to talk about expected value of perfect information, which is one of the subtopics in planning and decision making. Now, the expected value of perfect information is the value that you are going to get when you obtain perfect information. And the expected value of perfect information can be determined by taking your expected monetary value with perfect information, minus your expected monetary value without perfect information. So basically, expected value of perfect information, this we can simply summarize it as the value you obtain of flawless information. Information. I will start by showing you how you determine the value of perfect information using the payoff table. Using your payoff table. You can also determine the value of perfect information using your decision tree. But let me start by determining the value of perfect information using which method? Using payoff table. So using the payoff table, and we will go to a question on December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda Investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect information. So as to do that, we need to prepare a payoff table. So let's have the states of nature, and in this case, your states of nature were what and what? Remember, your states of nature, you've said, they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000, shopping mall, 110,000, 90,000, 90,000, residential, 90,000 is your payoff, 120,000 and 70,000. 170 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by 0.3. So expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay? So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, which is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? Because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And you've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum. I hope that is clear.
Hello candidates, and welcome to the Advanced Financial Management Learning session. The topic is mergers and acquisitions. In our today's lesson, we're going to discuss the regulatory framework for mergers and acquisitions. Regulatory framework for mergers and acquisitions. And in this lesson, we're going to highlight some of the regulatory bodies and legislation govern mergers and acquisitions in Kenya. And the regulatory framework for mergers and acquisitions in Kenya is designed to ensure fair competition and also to protect the interests of various stakeholders, where companies choose to merge or when a company decides to acquire another one. That decision is likely to affect many stakeholders like the employees, the management, the shareholders, the investors, the members of the public, and so on. And therefore, it's important that these transactions are regulated. That's why we have regulatory bodies in Kenya that help in ensuring that the interests of the various stakeholders are protected. So the first regulatory body is the Competition Authority of Kenya. One, Competition Authority of Kenya. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisition activities in Kenya. And the mandate of the CAK is derived from the Competition Act. It is derived from the Competition Act. This is an act of parliament that stipulates that there ought to be a Competition Authority of Kenya, which has been put in place since the year 2010. It is the principal legislation governing mergers and acquisitions, right? The Competition Authority of Kenya. It is the principal governing body. And the role of the Competition Authority of Kenya is to prevent anti-competitive practices that may arise from mergers and acquisitions. Do you understand? That is the primary role of the CAK. Is to do what? Is to prevent anti-competitive practices that may arise during these transactions, the mergers and acquisition. The second body is the Market Authority. Capital Market Authority, CMA. CMA, the Capital Market Authority, regulates mergers and acquisitions involving companies that are listed on the Securities Exchange, companies that are listed on the Nairobi Securities Exchange. So if the companies that are listed on the Nairobi Securities Exchange choose to merge or to acquire or to take over other companies, the Capital Market Authority has to be involved. The CMA has developed regulations, what we call takeovers and mergers. That is Capital Market Takeovers and Mergers regulations. These are regulations that guide the acquisitions and mergers involving companies that are listed on the Nairobi Securities Exchange. You understand? These regulations provide the framework for such activities. And the CMA ensures that there is transparency. The CMA also protects investor interests and so on, particularly the interests of the companies that are listed on the Nairobi Securities Exchange. You understand? So the Capital Market Authority, through the takeovers and mergers regulations, ensures that there is transparency, ensures that the interests of the public, the interests of the various stakeholders are protected. So this is the second body, the Capital Market Authority. The third body is the Central Bank of Kenya. The Central Bank of Kenya regulates mergers and acquisitions in the banking and the financial services sector. Banking, and financial services sector. Mergers and acquisitions that occur in the banking and financial services sector are regulated by the Central Bank of Kenya. And the Banking Act also requires that financial institutions should obtain the central bank approval for mergers and acquisitions. So we have again here the Banking Act as another piece of legislation that guide mergers and acquisitions in the banking and financial services sector. So the companies that operate in the banking and financial services sector that would wish to merge or to engage in acquisition activities, they must seek approval from the Central Bank of Kenya. The Central Bank of Kenya. Number 4, we are currently discussing the various bodies that regulate mergers and acquisitions. And the third one here is the Communications Authority of Kenya. Communications Authority of Kenya. Communications Authority of Kenya regulates mergers and acquisitions of companies within the communication sector. Within the communication sector. The fifth body is the Insurance Regulatory Authority. Insurance Regulatory Authority. Insurance Regulatory Authority, the IRA, regulates mergers and acquisitions of companies within the insurance sector. I can go on and mention such bodies and mention other acts of parliament like the Companies Act, the Companies Act, the Companies Act of 2015 provides the general regulations. They provide what we call general regulations for companies within Kenya, and it impacts how mergers and acquisitions are carried out. How mergers and acquisitions are carried out. You understand, candidates? Regulatory framework for mergers and acquisitions in Kenya. These are 5 bodies and the Companies Act. And in this lesson we've learned that the regulatory framework for mergers and acquisitions is designed to ensure fair competition, is also designed to protect the interests of various stakeholders, like the Competition Authority of Kenya. We've said this is the principal, it is the principal body. The Competition Authority of Kenya is the primary regulatory body that is responsible for overseeing mergers and acquisitions. And we mentioned that its mandate is derived from the Competition Act, which is the principal legislation governing competition and mergers and acquisitions. We've stated here again that the Competition Authority of Kenya, the role of this authority is to prevent anti-competitive practices that may arise from mergers and acquisitions. So this is the principal body, principal legislation. This is the principal body, and the principal legislation is the Competition Act. The second body is the Capital Markets Authority. The Capital Markets Authority, we've said, regulates mergers and acquisitions of companies that are listed on the Nairobi Securities Exchange. And the Capital Markets Authority has developed regulations that are referred to as the Capital Market Takeovers and Mergers. Takeovers and mergers. Takeovers and mergers, which provide the framework for mergers and acquisition transactions. Number 3 is the Central Bank of Kenya, we've said, regulates mergers and acquisitions in the banking and financial services sector. And we've stated that the Banking Act, which is an act of parliament in Kenya, the Banking Act requires financial institutions to seek approval from the central bank. Okay? Requires that companies within the banking and financial sector seek approval from the Central Bank of Kenya before merging. The number 4, we have the Communications Authority of Kenya, which regulates mergers and acquisitions in the communication sector. We've gone ahead to identify also the Insurance Regulatory Authority of Kenya, which you've said regulates mergers and acquisitions of companies within the insurance sector. So that marks the end of the lesson, where we've discussed briefly the regulatory framework for mergers and acquisitions in Kenya. Here is today's assignment. Number 1, what are the key objectives of anti-competitive regulations in the context of mergers and acquisitions? And how do these regulations aim to protect market competition? Number 2, how do cross-border mergers and acquisitions create complexities in regulatory compliance? And what international frameworks exist to address these challenges? I repeat, how do cross-border mergers and acquisitions create complexities in regulatory compliance? Number 3, how does the regulatory framework regarding disclosure requirements impact the transparency and fairness of the mergers and acquisitions process? Thank you for attending the lesson. We'll meet in the next lesson, where we continue to share knowledge in advanced financial management. Bye-bye. Hello and welcome back to the lesson. Today we are going to discuss mergers and acquisitions in the Kenyan, regional and global context. Mergers and acquisitions in the Kenyan, regional and global context. There are 3 things. First, we have the Kenyan context. And Kenya candidates has seen a rise in mergers and acquisitions, which are driven by various factors like economic growth, like market consolidation. And one reason for mergers and acquisitions is increased foreign investment. You understand? Kenyan context. Let's first briefly analyze mergers and acquisition in the Kenyan context. Here in Kenya, we've seen companies merging, we've seen companies acquiring others, and the reason has been because of the economic growth in the country, because of market consolidation. We've had also increase in foreign investments, and there has been mergers and acquisitions in various sectors, various industries. We've seen banks merging, that is the finance sector. We have telecommunications, we have areas to do with the consumer goods and so on. So one reason for the mergers and acquisitions in the Kenyan context is a growing market, because market has been growing. Growth in the general market. Now, in trying to understand mergers and acquisitions in the Kenyan context, you may also need to look at the regulatory framework. The regulatory framework, for example, we have the Competition Authority of Kenya, which plays a crucial role in ensuring fair competition. We also have other regulatory bodies such as the Capital Markets Authority, the Central Bank, and so on. These bodies oversee mergers and acquisitions in the respective sectors. So again, we have regulatory framework. Kenya has put in place regulatory framework that oversee mergers and acquisitions. That's why we've had successful mergers and acquisitions in the Kenyan context. In understanding mergers and acquisitions in the Kenyan context, you may also have to maybe discuss something to do with strategic drivers. Companies pursue mergers and acquisitions to expand their market share, to diversify their operations, and also gain access to new technologies. All right, we have strategic drivers, which I've mentioned. Strategic drivers. Mergers and acquisitions are driven by certain factors. You understand? Mergers and acquisitions in the Kenyan context. Then you have regional context. Mergers and acquisitions in the regional context. And regional context, here we are referring to the East African integration or community. The East Africa community promotes regional integration, leading to increased cross-border mergers and acquisition activities. And Kenyan companies are actively expanding into neighboring countries, and also companies in neighboring countries are also expanding their operations into the Kenyan market. So we have the East Africa integration, East Africa community. We also have COMESA, the common market for Eastern and Southern Africa. COMESA also influences mergers and acquisition activities. COMESA also has regulations that apply to transactions in multiple member states. You understand? Then we have also regional banking expansion. Kenyan banks have been particularly active in regional expansion through mergers and acquisitions. An effort which seeks to tap into the larger Eastern African market. Global context, mergers and acquisitions in global context. Mergers and acquisitions in global context. These mergers are influenced by global trends. Global trends. What do we mean by global trends? Now, global The global mergers and acquisition trends influence activities in Kenya and even the region. Factors like technological advancements. We have factors like the economic conditions, the geopolitical events. Such factors play a significant role in mergers and acquisitions in a global context. You understand? So global trends are influenced by technological factors, technological advancements. We have factors like the geopolitical events, the geopolitical events which influence mergers and acquisitions in the global context. Economic conditions also play a crucial role. Global economic conditions. Global economic conditions. You understand? So, apart from what we've discussed, we also have cross-border deals. All right? Cross-border deals. Kenya is increasingly involved in cross-border mergers and acquisitions. Both foreign companies acquiring Kenyan businesses and Kenyan companies acquiring foreign businesses. I've talked about also the technological influences. We have global technological advancements which are driving mergers and acquisition activities. Companies are merging to gain access to new technologies and also digital platforms. So do you understand, candidates? So that's what we can say about mergers and acquisitions in the Kenyan, regional, and global context. Kenyan, regional, and global context. In this lesson, we've learned that Kenya has seen a rise in mergers and acquisition activities, which are driven by many factors. I've mentioned growing market. Kenya has put in place regulatory framework. We also have certain other strategic drivers where companies pursue mergers to expand market share, to diversify their operations, and also to gain access to new technologies. We've gone ahead to discuss mergers and acquisitions in the regional context.